Will the Trump tariffs plunge the U.S. economy into recession? Connor Lokar is senior forecaster at ITR Economics. Hello, Connor.
Hello, Robert. Thanks for
Thanks for
having me.
thanks for joining me. So, there's been talk of a recession being triggered by the tariffs imposed or threatened by the Trump administration. Do you consider this likely?
Likely, no, not at this point. Possible, certainly yes. I don't want the statement that we don't think that at least at present that there's going to be a recession based on what we know now is an endorsement of tariffs. We would prefer not to see the world go in a dramatically accelerating and retaliatory, escalating global trade war because we do not think that is productive. But with what we know now, steel, aluminum, China, we think we're okay. If we find ourselves 6 weeks from now with 25 points, finally, maybe at some point, on Canada and Mexico and Europe and Japan and South Korea and others, that might dim our thoughts. But with what we know so far, we think that the economy can still grow despite some tariff pressure.
So, what underlies your feeling about that? Is it the relatively small portion of trade that actually accounts for U.S. GDP? Is it something else? I mean, why do you feel that way?
Well, coming into this year, the momentum is improving. We would argue that the economy is actually coming out of a recession in the last year and a half, depending on what
Really?
you look at. I know that didn't show up in GDP over the last year and a half. But if you look at basically every other data set below that line, we saw recession on a leading basis in the single-family housing market. We saw recession in inflation-adjusted retail outcomes, depending on what deflator you use. We saw recession in freight volumes, trucking employment, generally the entire logistics space, recession in most wholesale channels for durable and non-durable goods. We saw recession in U.S. manufacturing outcomes starting in late 2023, 2024. So coming into 2025, prior to tariffs, our worldview is that the economy was actually gaining momentum after any absence of any real meaningfully positive momentum in the last year and a half. We see that inflation-adjusted income levels are rising at a level that's consistent with 10-year averages, which is way better than they were 2 years ago, coming out of the peak of the inflation numbers in 22, 23. The economy has started to adapt to the higher interest rate level that, it was really the interest rate change to the upside that was so negatively impactful in 22, 23. So before the tariff exercise started, we were reasonably optimistic for 2025, 2026 to eke out some not crazy growth, but modest growth in the next couple of years. And really the question, the numbers that we're trying to run here is basically, do we have enough at this point that we need to scrap those expectations? And we're just not there yet.
And
With the admission that we're still waiting on, hopefully at some point, clarity on what tariffs are actually going to go in place, how long might they stay there, and also the data. If we look at some weekly flash data points, Johnson Red Book weekly retail sales, they look fine. Weekly economic index softening a little bit, but nothing catastrophic. So when the data tells us to stop and change our view, we will, if it gets to that point, but we're not there yet.
but you say the economy is adjusting to inflation. Do you think then that the tariffs will not actually have an impact on inflation and interest rates?
No, we do think it will have an impact on inflation. We're never in the camp that inflation was, we did not believe inflation with or without tariffs was going to go to 2% or 1% or 0%. Our forecast prior to the election and coming into this year was that inflation was going to average near 3 points in 2025, a hair above that, current rates in the high 2% range. So basically consistent throughout the year. However, even with inflation at the numbers that we're seeing now, we're seeing that wage growth is inflation-adjusted disposable income growth at about 2.8%. Over the last 10 years, it averaged 2.7%. So that's a very healthy number. That number was pretty close to 0% in late 2022, 2023. So it's in a fundamentally healthy spot now. We do view tariffs as inflationary in some areas. And then again, the question is that additive inflation pressure going to be enough to undermine that rising income trend in what so far is actually an improving set of consumer outcomes here this year. So, if we end the year at maybe, I'm just making up numbers, but say year-end inflation ends at 3.7% instead of our target closer to 3 because of tariffs. I don't think that kills us. If it ends at 6.7%, that probably does in terms of undermining, the consumer and basically inflation eating all of that wage growth and
But to some extent, manufacturers have to feel the effect of these trends, do they not? And if so, what might those
100%. Yeah,
impacts be?
absolutely. And Our consulting base is a lot of manufacturing and distribution. Really all of our clients are on the make, move, sell side of the economy. I'd call it, if they're manufacturing something, distributing something, selling something, if it's a physical good or construction, that's who we deal with. And there's going to be winners and losers, probably more losers than winners. I have some steel product manufacturing clients domestically that they're excited about tariffs. They're already getting volume commitments from their customers. They're going to get pricing power in the market. They're going to do better this year, likely, than they may have otherwise in the absence of tariffs. Now, a lot of our other clients purchase steel and aluminum that's now going to be more expensive for them, or they're importing components or different products, and they're going to have to manage how they're passing their prices through the value chain to their customers, and can they justify it? Can they get all of it? And so it's definitely going to be highly disruptive, particularly to individual companies. From the highest macroeconomic level, again, we're not prepared to say that it will be, again, fatal to our forecast of growth at this point. But because of the fluidity and the volatility of the situation, that could change. I don't want to say that no matter what happens, we're not going to come off of our opinion, but we're just not prepared to do so at this point.
So you're saying that the way things look now, it looks like the United States will not be affected by tariffs to the effect of being driven into recession. But what about Canada and Mexico? Is the picture different there?
It could be, obviously, if you look at the basic math, Canadian or Mexican exports into the US as a percentage of their GDP, it's much more significant than, say, our exports into their economies. And when you look at their numbers, Mexico industrial production, which is looking at the physical goods side of their economy and manufacturing, they're sliding into one as 2025 begins, even before this started. Canada, kind of similar to the United States, they're actually kind of limping out of the United States, or excuse me, limping out of 2024. They were negative for most of the year. They barely got above zero at the end of the year, and now we're dropping tariffs on their heads. So there's certainly a prospect that it could maybe forestall some Canadian recovery. It could worsen some of the weakness that we're seeing prior to tariffs in Mexico. The U.S. is right on the line. Again, we're just climbing out of one. So there's some risk there for us as well. So it's very different than early 2018. I'll call it Trump tariffs 1.0, which were seemingly less broad, depending on how things go in the next 4 to 6 weeks. But that was at the top of a business cycle. U.S. economy was strong, Europe's economy was strong, Canada and Mexico were strong. Those were layered on in a period of what I would call relative strength in the business cycle. And this is kind of the inverse 7 years later, where everyone is kind of limping out of 2024 into 2025. And then, so this is a somewhat vulnerable portion of the business
I'm
cycle.
kind of surprised to hear you say that Mexico's sliding as well, because I was under the impression that we keep hearing about how robust its manufacturing base has been recently, as so many manufacturers seek to nearshore production from China into Mexico to serve the U.S. market. That wasn't enough to stop Mexico from sliding, as you say?
Well, it's really interesting because we actually did see that in the data, that nearshoring phenomena. Mexico, if you look at average growth rates post Great Recession on, typically U.S. is going to be 1, Canada is going to be 2, and Mexico typically 3, lagging. What we saw was that in 23, 24, their growth rates actually outperformed the United States and Canada, which is not super typical. So at the time, we read that as nearshoring, and basically finally probably investment commitments made in 2021, 2022, starting to bear fruit in terms of Mexico manufacturing volumes. But for whatever reason, that momentum faded late in the year last year, and put themselves, after kind of beating us for a couple of years, now they're sliding to the low side while we're coming out of that relative malaise.
Interesting. Okay, so how do you view the long-term trend in light of what appears to be a push toward nationalism? What is your economic outlook for the long term, say into the next decade or so?
Well, the winds of economic nationalism have been blowing for years at this point, pretty much in one direction, and we think that that's going to continue, which we don't love. In our perfect Austrian economic free market worldview, we would not be doing this, and there would be no tariffs. Everyone would trade freely, they would trade fairly. Some countries, some regions would do some things better than others, but we would all trade, and net, everyone would be optimized for it. The birds are chirping, the sun is shining, end scene. Obviously, we understand that it's a much more complex global environment than that. And we're going the protectionist route, which we think is poor for long-term global relations. We think the probability of outright conflict with other countries falls dramatically when you are deeply embedded trading partners, and as those relationships fray, I don't know if that is the best thing in the world. And again, it just leads to less efficient outcomes. Our view would be the government's not sticking their fingers in the pie, and the winners win, the losers lose. And if we find that our manufacturers cannot compete in the absence of tariffs, I think like tariffs are kind of treating maybe the symptom, not the cause. And we need to ask, why is that the case? Can we do better on, other, maybe it's tax related, regulatory related, environmental reg related. But tariffs are, we don't love that this is
Yeah,
the way
but
it's going.
it's
But we think it's going to continue,
my
unfortunately.
understanding is that ITR's outlook is even more dire than that, that you are actually predicting a 2030s Great Depression. Is in fact that the case, and if so, why?
It is. We've been predicting this since I started with ITR 11 years ago. And tariffs and protectionism may end up being a part of it, but really the causal drivers of that depression outlook is it's basically it's demographics, it's entitlement spending, it's the debt that we built up to this point, and the fact that we just don't think that as a nation you can spend trillions of dollars more than you bring in every year and just have that work out in the long term.
Hmm.
We feel that the bill comes due in the 2030s, baby boomer retirements and their inversion from wealth creators, equity purchasers, bond purchasers, taxpayers pivoting into the most prolific entitlement resource consumers the world's ever seen. And again, shrinking and drawing on government resources, we think the math becomes untenable, and it could be ultimately exacerbated by reactionary protectionist trade policy. Comparison folks have been making quite often in recent weeks is looking at the Smoot-Hawley Tariff Act back in the 1930s, where that exacerbated the
Yeah,
Great Depression
yeah.
back in that time.
So,
So we would hope that we don't do that again, but history does have a way of rhyming at
mhm.
times, and so we would prefer that the world didn't move in this direction, but we're not in charge. We're just left to
And
analyze it and pick up the pieces. So,
some are saying it will be called the Great Reset, the attempt to deal with all of this debt, and it's going to finally come home to roost. But it sounds like that's what you are at least foreseeing.
mhm.
Very interesting. Well, Connor Lokar, thank you very much. I can't say it's a gratifying outlook, but thank you very much for your candor and look at what's going on today, also in the economy of the United States and elsewhere in the world. Thanks very much for being with me today.
Thanks for having me.